it's always really, really easy for you as a founder if things are going great. You are in TechCrunch, you are in all these publications, you are in podcasts, everyone talks about it. But in the moment where you are really, really struggling, a lot of people don't see that because the news outlets are only covering the great stories. And B, you really have to fight through. And I think this is also what divides good entrepreneurs from bad entrepreneurs.
Hey everyone, this is Prashant and I'll be host of the VC10X podcast. And today we have Max Fleit with us. Max is a founding partner at Wizard Ventures, where he is building a portfolio of internet businesses. In this episode, we talk about why you should not raise VC money, expectations that come with VC money, difference between VCs and angels, what all info should your pitch deck contain, at what stage should founders seek external funding, and a lot more. So without wasting any time, let's dive straight in. Hey Max, so good to have you on the VC10X podcast. How are you doing?
Doing very well. Thank you so much for the invite. Really looking forward to this.
Yeah, it's my pleasure. Absolutely. So to start things off, can we have your story to have some background before we start the conversation?
100%. So I'm based in Berlin right now, 30 years old. I've been building businesses since I was 15 years old. So started out quite young selling stuff on the internet. At the beginning, it was more like a service business. So web design, but also custom coding. And then I created my first browser game back then. So back then, a lot of the internet was full of these like games and everything. And I created the first one when I was, I think, around 15 or something. And it was back then so much fun just to build things. And it was so crazy to see that in the course of, I don't know, 6-7 months, I got like 10,000 players into the game. And then I was just like running home from school and building on the game. And it was so cool to see that grow over time. And to be honest, back then, I didn't really have the idea that I wanted to become an entrepreneur. I was just enjoying the things. And I always thought to myself, how is it possible that I can earn money building things that I enjoy? And so after my school years, I then switched to studying industrial engineering combined with mechanical engineering. And during that time, I think like college for me was quite boring because it was very theoretical, and I'm more the type of person that loves to build and create on his own. But luckily, during that time, there were certain exams in the college or in the degree that were really, really hard. So around 90% failed things like thermodynamics, technical mechanics, and all the hard subjects. And I had the luck that I had two good friends of mine, and they were really, really good in explaining certain things. And so back then, for me, it was easy to pass these exams. But also for a lot of like fellow people in the university, they thought, hey, you can explain it way better than all the professors, all the tutors that we had in the university. And out of this, we created our first bigger company. So back then, the idea was, hey, why not take like 50 to 100 people, bring them all together in one room, and then charge every one of them, I don't know, 5 or 10 euros instead of like 15 euros that you would charge a single person for an hour. And suddenly a new idea was born because we had created these kind of like crash courses or exam preparation courses. And at first it was just like a really, really good way to earn money for us while studying. But then we realized, hey, this can be a real business. And at that point, we spent most of our college days working on the business idea. We hired the first people, asked friends to join, and just did the exams of our degrees at the end of every semester. And luckily, we finished the degrees, but most of our time was already spent on our company. And it was so crazy to see because we were like earning money from day one. And that made it really, really easy for us because we were just living on a very, very small budget together in one apartment. And so we were taking all of the money that we earned through our education business and put it back into the business. And that led to us scaling the company significantly. So we grew it to over 200 cities in Germany, but also added an online tutoring layer on top of that. And this was all bootstrapped at that point. And that was really, really the best time of my life because we were just having fun. We were earning money. We were growing our business. And we weren't thinking so much about how we'd actually create a huge company because there were no reference points for our journey. And then at some point in the journey, we got an acquisition offer. And I think at that time we were around 1 million in revenue or something. And then one strategic buyer was coming and said, hey guys, I want to buy your company. And we were in our early 20s back then. And so we decided, hey, no, we won't give away our company because we will be the market leader one day. So very bold, very ambitious, but also a little bit stupid looking back at that time. And this was also the time when we came in contact with venture capital for the first time. Till that point, as I told you, we had bootstrapped the company and everything was going quite well. And we were really, really scrappy in spending our money. But then we thought, hey, why not raise money from VCs and then spend the money on quicker growth? And really, at that point, we were also, hey, instead of just selling the company at a valuation right now, maybe we can raise money at a way higher valuation. And that was also the case. But we weren't really familiar with like A, the common terms, but also B, what it meant to raise venture capital. Because for us, it was the first time in our history that we had so much money that we can spend. And honestly, we spent it on a lot of stupid things. So we were hiring as quickly as we could without really having a plan on which people we needed and also which kind of values we wanted to have in our company. And B, we were spending the money on a lot of like stupid things like testing TV commercials, but also a lot of, I don't know, events and all of that. So we were burning through the money quite quickly and realized this like, I don't know, a year later or something, and then had to restructure the company. So we're going to lots of ups and downs in that journey, but managed to do that. And luckily, the company still exists right now. My co-founders are still managing the company. And for me, it was like this huge experience. And for my personal development, this was really bringing me to the next level. But at some point, I thought, hey, I want to see something new. And that was around 2.5 years ago when I left the company on an operational level and became a full-time investor. So over the last 2.5 years, I looked at thousands of pitch decks, talked to thousands of founders about their ideas. And the interesting thing here is how different it is to be an investor than being an entrepreneur. Because for me, as an entrepreneur, I always needed to be very, very positive. So no matter the problems, we were really aggressive, trying to face them, and thought, hey, we just have to walk through the wall and make it happen. But on the other hand, as an investor, it's your job to say no to 99% of the companies that come to you. And this is such a shift in mindset. And especially for myself, it was really, really difficult because I'm more the type of person that's quite positive. So if you come to me with a good idea, I say, okay, let's just do it and we will figure it out on the way. But then the likelihood is quite huge that you end up with a mediocre portfolio or really very close to a lot of the founders you work with. And then you are in the journey with them together and have to fight the fires. And so this is for me very, very interesting in terms of perception. And this is also, I think, why a lot of founders that turn investors have a hard time, but also the other way around. If investors become operators again or become founders again. But yeah, so far the journey has been great, and happy to be here and talk about this a little bit today.
Yeah, sounds amazing. And since you have turned an investor and you have this past experience of being a founder yourself, you've been in the nitty-gritties of running the business, first a bootstrap business and then a VC-backed business as well. So you have all sorts of experience there. So how does this experience come into play when you're evaluating startups that are pitching to you? What are you looking for in these founders? That can they actually handle the kind of pressure that comes along with VC money?
Yeah. So first of all, I think everyone who gives entrepreneurship a shot is like someone that is, it's impressive, because being an entrepreneur is really, really hard because there are so many ups and downs in your journey. And I haven't seen a single company in my portfolio, but also for the businesses that I built myself, that was just going into the right direction. And I think it's always really, really easy for you as a founder if things are going great. You are in TechCrunch, you are in all these publications, you are in podcasts, everyone talks about it. But in the moment where you are really, really struggling, A lot of people don't see that because the news outlets are only covering the great stories, and B, you really have to fight through. And I think this is also what divides good entrepreneurs from bad entrepreneurs. So good entrepreneurs are really there in the hard times and struggling together with the team and fighting through. And for me, this is really, really important in terms of assessment of a company. Because especially if you look at the funding climate of the last 2, 3, 4 years, it was so easy to raise huge amounts of capital. And now a lot of companies that have raised money are struggling a little bit to raise the next follow-on around. And now you can see the entrepreneurs that are still doing and pushing really hard, and the ones that say, "Oh no, if it's hard now, I call it a day or something." And so for me, the team is really, really important. But also, one thing that I would always make sure as an investor is the alignment between investor and founder. Because to be honest, when we raised first capital from VCs for our business, I wasn't aware of what that really meant for the company and our own journey. So back then, I thought, okay, we are just going to raise one round of funding and then we will be profitable again. But I would say in 99% of the cases, that's not going to happen, because you are building so much costs, like you are hiring so much people, and then coming back on track in terms of profitability is really, really hard. And in our case, that led to a little bit of a misalignment between us as founders and the VCs, because for them, it's really, really important to take a shot on building a huge business with every single investment that they do. Because only if they do that, the economics of the whole fund would work. Because as you know, I don't know, you're investing in 50 companies, 40 of them will go broke, 5 will return a 1x or something, and the winners have to cover all the losses, but also the profits for their limited partners. And I wasn't really understanding that till the moment when I started investing on my own. And now, if I'm talking to founders, I'm really asking them the hard questions. So, do you really want to grow as quickly as possible and take the shot of building a huge business with all risks that are associated to that? Or is it maybe better in your case to bootstrap the company or just raise money from angels because they have different expectations? And I have the big belief that a lot of founders and companies that are raising money shouldn't raise venture capital, because they don't want to build these like huge massive businesses, and B, the model or their business model, their industry is not made for it. And so I would always make sure, if I'm doing investment, if the alignment is there, and also make sure with potential co-investors that we have enough education on both sides of the table. And luckily, there is a lot of education coming up over the last years, because founders share their stories, investors share their theses and everything. But I think this could be 10x over the next years to really have this alignment for the future.
Yeah, absolutely. And this is something that a lot more VCs need to emphasize, that not all businesses are VC backable. And not all businesses need to be VC backed as well. You can still build a successful business without VC money.
Yeah, and
You don't always need that. Yeah.
yeah,
Go
and
ahead.
this is so interesting, because also from a personal perspective of the founder, in a lot of cases, it makes more sense to create a profitable lifestyle business than a VC-backed business. Because imagine you are building a software company, and you can bootstrap a software company, you and your co-founder, to, let's say, 1 million in ARR. So the average multiple on software businesses right now is maybe somewhere between 4 to 9 or something. So if you sell the business, and today it's getting easier to sell these kind of businesses through platforms like MicroAcquire, you have a life-changing exit for yourself and your co-founder. But if you want to have the same amount of exit proceeds for a VC-backed business, the business must be, I don't know, 10x bigger or something. Also because of liquidation preferences that you have with your investors, the several rounds of funding, and all of that things. So for a lot of businesses, makes sense to rather bootstrap them or use things like revenue-based financing. And then there are other businesses that can and should be venture scale.
Yeah, absolutely. And the recent brand change of MicroAcquire was from MicroAcquire to Acquire. So just to clarify that, and then like this is a model that needs to be popularized more and more, because even though this is a VC podcast and we are mostly talking about venture capital, it also serves the venture community to let people know that venture is not the right choice for everyone, right? And there are alternative pathways, and you have to make the right choice for yourself. Do you want venture money, and what are the expectations that come along with venture money? That needs to be also conveyed very clearly, because it is often the case that people are just starting a company, they have an idea, and the next thought they have that, okay, how can we raise money on this one, right? But that's not always the case. You can also build a sustainable business just based on profits, and then just like you sell, you have an exit. In case of a venture backed business, you can have a similar kind of exit in a self-sustaining business that is generating profits, and you can sell it on a platform like acquire.com, that Max just mentioned.
Yeah,
So
and
that's
it's
also another way. Yeah.
yeah, and so interesting
Go ahead.
also. If you just read the news from some of the exits, there are these huge numbers about the exit amounts, but for a lot of the cases, you really don't see how much money goes to which kind of person on the cap table. And also from an investor perspective, sometimes I think it's so funny if, just an example, all the quick delivery players that we have right now here in Europe, a lot of them raised, I don't know, even $1 billion of funding for example, Gorillas or something. And now they are probably selling for an amount that is way lower than even the invested amount. And that means only the investors that came in at the latest are getting their money first. And imagining also from an angel perspective, if I invested in a pre-seed round on the journey, the investment for quite a long time was really, oh, okay, this is a 100x markup or something. And then in the end, I don't get a penny right now as an investor, and so do the founders, because all these like liquidation preferences stacked up over time.
Right, absolutely, I agree. Like there is a big risk involved in all these investments. Like, and the likelihood is actually that you won't make your money back. These are like a riskier asset class, but you can actually make 10x if that's one scenario that's possible. And the other scenario is that you lose all your money. That's also another scenario. And
Yeah.
another aspect that you highlighted is of the lifestyle business, that actually a business that is run on based on profits and in a self-sustaining way is actually completely different from the same business once it takes venture money, because then it is chasing some expectations that, okay, we are going to be 3x in this month, or maybe growing at 30-40% month on month. And because you need to do that in order to fulfill the expectations of the investors to be ready for the next round, otherwise you won't raise the next round. And you can't just say like you said, like, okay, we were just planning to raise one round and then be profitable forever. Like, you actually cannot have that mindset, because the investors want you to raise further rounds. They want you to go after that big exit. That's where the interest lies. So, and that's where that misalignment of interest comes in, right? So it is very important that we communicate, including the investor community, to communicate this upfront, that these are the expectations that are going to be attached with this investment. Are you fine with these? Are you building this to be a like really big business and want to sell it one day? Like, even if you don't have an inclination to sell it one day, like, do you plan to make it so big that one day maybe you go for an IPO, right? Because that is when the interests are aligned. If not, they're not aligned, right? uh, Great. So amazing that we talked about it on this episode. I haven't touched upon that yet on the podcast. Besides, since you are an angel investor, so once you have made this clear that, okay, uh, this alignment is there, then what are the next things that you look for in the founder to see if you want to make an investment
Yeah.
or not?
Yeah. So first of all, I think there's also the difference between angel investors and institutional VC funds. So if a VC fund invests, they have limited partners and they have the obligation to return profits to their limited partners in some sense. And if I'm investing my own money as an angel investor, I could be also fine with returning 1x or 2x over 10 years, because I don't know, I want to give back to the entrepreneurial community and I'm not so interested in taking the returns. So I always talk with founders about, hey, just raising from angels could also be an option if they are aware of the expectations. But in general, besides all this like nitty gritty alignment things, I think for me, the most important thing to look at is the traction that the company has. And it's so crazy. If I talk with founders, a lot of them always think about traction in terms of revenues or something. But for me, traction is everything that happened since the moment that they started to think about an idea. And that means in the stages where I invest in pre-seed, seed, this can be literally everything from hiring a team to user interviews to first people on a waiting list to revenue. And so founders can be very creative about showing the traction. And for me, it's so important to see that the founder has really understood the problem that the customers of them have. Because only if it is a pressing problem, you can build a really, really sustainable and great business out of it. I always struggle a lot with companies that are selling vitamins and not painkillers, because there are successful companies that are selling vitamins, but in the sales process and also in the growth journey, it's always easier to sell something that the people really want. And also from a mindset perspective of a founder, it's way, way easier if you have something that you can walk out to the people and say, look at this, this will really solve your problem, instead of saying, oh, this might be interesting for you. So for me, the two things, team and traction, are the most important things to look at.
Right. Right. Great. So those are two amazing things to look at while you're evaluating early stage investments. And like you just mentioned, like it's actually different while raising from angel investors and venture capitalists, and that is why we call them angels, that they actually believe you more and they're more in your interest, and they can be working more one-to-one with you and not just care about the returns. And that's why you also should choose the kind of angels that you are trying to pitch to, and angels with prior work experience like yourself can come in really handy over there, because you've been through that journey of being a VC funded business as well as building a profitable product just based off your own money. And that alone, it takes a lot of effort to do, because you're not taking any external funding and building a profitable product just based on unit economics. So you can help companies figure that out, right?
100%. Couldn't agree more.
Right, absolutely. Also, you have this product called basetemplates.com, where you've helped a lot of founders prepare the perfect pitch decks and help them raise capital from venture capitalists and angel investors. So, can you help us? Like, what all info do you think a pitch deck should contain for an early stage founder?
Yeah. So base templates as a business that I own is something that felt very natural to myself, because as I told you earlier, I made all the mistakes myself. And so at some point I thought, hey, why not share my lessons with the next generation of founders so that they don't make the same mistakes again? And this resulted in me creating a lot of templates, contents, and also services for founders. And they really like my way of thinking about it, because I have been in their shoes. And if I'm thinking about a pitch deck, so there are some things that are really, really interesting. First of all, a pitch deck is here to open up a door towards an investor. So it's our first foot in the door, and we want to make sure that we make a very, very good impression if an investor gets the deck. And that means specifically leaving as much information out as possible. And this is what a lot of founders don't understand. So I think statistics say that the regular investor takes only 3 minutes to look at a deck or something. So I would make sure, if I build a deck, that I just include the major information that shows the opportunity, the problem, the solution, the team, and the traction. And I use this 3 minutes to show the main information and raise the interest in the investor. Because if I have the foot in the door, then we have the personal discussions. I can tell them more about the product, about how we think about different angles and everything. But I don't want to overwhelm them with 20 slides of information, everything in detail. And so for me, a good pitch deck, maximum 10 to 15 slides, and it should include all the major slides that you can see in almost every successful pitch deck. And it's not so much because another structure wouldn't make sense. It's more about giving the investor who looks at the deck a structure they know, because they are looking at a lot of decks and so they want to assess it quickly. And if the structure of a deck is different from the ones that I get as an investor on a regular basis, for me, it takes way more time to look at the deck, think it through. And so I really would make sure to have this common structure. That means starting out with a problem, then having a solution, talking about the product itself, then the market. Also interesting always why now is the right time to build it. So do we have a move in technology? Do we have something like COVID and more people are working remotely, or other like changes in the market dynamics? And then moving over to the second half of the deck, that is around traction. So what have you done so far? What is your team? And last but not least, what are you asking for in terms of money and where it will bring you? And me personally, I'm a very analytical person, so I like to have a lot of specific details. So instead of saying, I'm going to raise $1 million and we are going to build up a sales team with that, I want to know exactly what kind of people are you hiring, which kind of marketing efforts are you taking, and where will the money bring us as a company? So will we be at 1 million ARR with the investment? Will we be at 50 users, 100 users? So very specific. And then I'm really, really good off and want to take the call.
Yeah, absolutely. Those are some great things that founders can really benefit from by including that in their pitch decks. And one more thing that I want to ask you is, at what stage do you recommend should a founder go and seek external investment? I know that there are investors available at practically every stage. There are people willing to fund your business even before you have an MVP. So at what stage do you recommend that a founder should actually go for external funding that's in their best interest?
Yeah. A lot of founders that I talk to, they want to have an investment before they actually take the leap and take the first steps. Me personally, I would always try to validate the idea as much as possible before raising external capital, because I want to have a good standing if I'm going to raise capital. And that means if I have some kind of traction, it's way easier to persuade investors. And B, these are people who trust me and my idea, and I want to make sure that I can really deliver on the things that I said I will. And so I would wait till I have any kind of, I don't know, MVP, product market fit, traction, alignment with customers, and then go out and raise money.
Yeah, that makes a lot of sense. And besides, this will be my last main question before we move on to the rapid fire section. So this is about what change do you wish to make in the angel community, or what change do you wish to be as an angel investor? What are you trying to do differently as an angel investor?
Yeah, this is a really, really interesting question. So I think for me, it's two things. So the first thing that I want to change, I want to change the way founders think about their cap table and angel investors in general. So in the past, there was always this kind of like mantra, oh, just get as few investors on your cap table as possible, because they will want to take some, they want to also take decisions. They are asking for information and all of these things. But I really believe that a lot of investors on your cap table can really have a huge value for you. So obviously you have to pool them in some kind of way, SPV or something from a legal standpoint, but every single individual that you can take on board has something very unique to their experience and also to the things that they can share. And for me, when I started out investing, I was very, very unsure about my own value add that I wanted to give the founders that I work with. So I always said, hey, if I can be helpful, just text me. And I never understood why no one texted me. But now I do, because it's so unspecific. I don't know. The founders don't know if they should ask me about sales, about marketing, about hiring. And so right now I'm very specific about the value add that I can give to my founders. And I say, hey, there are like 3 things that I can help you with, and I'm really good at that. But with everything else, go to the other angels and ask them. And I want to change this for also all of my angel friends, that they become more aware of their strength and the stuff that they can really add value with.
Yeah, absolutely. Yeah, being clear with what specific value add can you provide is an incredible thing for that. Also brings a lot of clarity to the founders, because there are a lot of investors who are saying, okay, we are just a call away. We are here to help you. But then when there is a need for help, their founders are like wondering who is the right person for this exact problem. And that is where it helps to be clear with your portfolio companies and founders that where you can add value. Amazing. So moving to the rapid fire questions, I have 5 quick questions for you, which is regarding your investments, and you have to give 5 quick answers. Are we ready for it?
Yeah, let's do it.
All right. So the first one is, what are the sectors and regions you invest in?
Yeah, so regions I invest globally. Focus right now is still on Europe and the US, but would love to do also some investments in Africa soon. And the sectors that I invest in are software as a service, education, any kind of community driven product, and then some special thing is fintech, but related to startup investing. So infrastructure for investors, for VC funds. This is what I'm really passionate about.
Amazing. And what's the typical stage of investment?
Yeah, the earlier the better. So pre-seed, seed is totally fine to me.
All right. And what's the typical check size?
Typical check size somewhere between 10 to 30K.
Okay. And where can founders pitch you?
Founders can reach out to me on a Twitter or my own website. So maxfleit.com. There are also a lot of portfolio companies that I have, a little bit more about my thesis. And just send me over your deck, but also please add or include why you think it's relevant to me and my thesis. And then we can hop on a call afterwards.
Absolutely. And last one, where can our listeners follow you?
Yeah, for sure. So 3 platforms. I'm very active. First one, LinkedIn. I create a lot of content there. Same for Twitter. And around 3 months ago, I started to document my journey on YouTube. Same. So make sure to subscribe on YouTube on startup investing, but also building your startup from the founder perspective.
Sounds incredible. I will make sure to plug all those links in the show notes below. Thank you so much for coming on, Max. It was a pleasure hosting you and love the insights that you share. Happy investing.
Thank you so much. No worries.
My pleasure.